Welcome, everyone. It's Tuesday, May 5th, year 2020, and welcome back to our weekly market overview, where we try to keep you up to date on everything that we're seeing out there last week, what we see upcoming this week, and how we're looking at the portfolios. So today we're going to do our normal review, and then we're going to talk about active money management. For the last few weeks, I've been focused on areas in the market that we're examining. But a lot of the questions I've been getting around the process of building your portfolio and managing the portfolio and how we account for this risk. So we're going to talk about that at the end and how we implement that during a time of volatility that we see now. As always, I'm Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. Those of you that know me, of course, have been at this for many, many years. And those of you who don't, feel free to reach out. We're happy to send you some information on our team's background and what we do. As always, this live recording is for information purposes. It is not meant to be advice. Do seek advice from a professional. Do your own due diligence before acting on any investment strategies. We're happy for any of our clients to reach out and review their plan, strategies, and what's going on in their portfolios or their larger financial plan. And if anyone's interested, we're happy to discuss with you how we might be able to help and point you in the right direction. And also remember, the information that we provide here is as up to date as we can be and as accurate as we can be, but do your own research to make sure if you act on any of this that it is current, as things have been changing very quickly. So before we get started, just on the technology front, you are all muted, both video and voice. So if you've got something going on in the background, don't worry, it won't come through. And if you're still in casual clothes and not getting dressed up midday yet, don't worry about it. We can't see anything on the camera front. If you do have a question, in the middle at the bottom of your screen, you'll see that Q&A button. You can click on there and just type it in. We'll see your questions and we will certainly try to address them at the end. And if we cannot, or due to lack of time, or if it's more involved, we'll be happy to reach out to you, or you can reach out to us, and we will try to answer all your questions. So before we get started, I always try to, every week I try to focus on a charity. This week I just want to talk about local businesses. One of the, we talk, when we're talking about the markets in general, we're talking about the larger companies that are struggling out there, and they're trying to reach out, figure out ways to continue revenues and continue to serve their clients. But the ones that we don't want to forget are our local businesses. And this isn't, we often talk about the restaurants, but there's a lot of local shops. I do want to recommend everyone reach out and help. And some of the ways you can do that is buy gift cards. If you normally support a business that's currently closed or limited services, buying a gift card for future goods or future services allows them to not only continue the revenue stream to keep them going, but also helps keep people employed and secure the future of their businesses. Delivery, whether it's goods or food, most of them are doing curbside pickup. A lot of them have delivery services. I know that we've been taking advantage of the local microbreweries in North Vancouver here. We're all delivering for free in North Van. I've used this the last 6 to 8 weeks as an opportunity to try some of the ones I hadn't tried before. And we found some really excellent ones along the way. So do try to help where you can and from that front. And do the pickup. I find, sometimes the delivery services, they're great and they're very convenient. They tack on a bunch of fees sometimes, and sometimes well deserved. I'd like to see more of those fees go into the actual drivers, but with doing the pickup, being able to still see the proprietors and the owners and seeing the people working, I find it keeps me in touch a little bit. Also online, a lot of them still have online services. You can go in and order even for now or later. And I'm not talking about the big box chains. Of course, we're talking about the little shops, the local owners or community owners. Tip like a boss. There was a study out actually during this process that tipping has dropped, and it's mostly related to we don't have the personal contact anymore. So people are doing the drop off at your door. A lot of the food delivery services are just dropping and leaving, so there's no personal contact. And without seeing the face, without seeing the smile, people are tipping a little bit less. So do to keep that in mind and try to support the people that are out there working, probably at a reduced income that they're used to. You can schedule services for later. We are starting. We're going to talk more today about opening up the economy again. So if you need a service, scheduling it, book in that service for them so that at least they have the calendar filled up. Is well worth it and will really help them out. And of course, say thank you. They're all trying their best to cope with the shutdowns and the social distancing, but reach out to your local community, your business owners, those little shops, those little specialty grocery stores, or your favorite restaurants. Reach out to them and let them know that you're still there and you're going to support them again when we reopen. So let's get going. Let's talk about what's new this week. Again, as I mentioned last week, we're not going to focus as much on the virus, but more the economic effects, because that's what we're really watching right now. And what we're seeing in the economy, especially in the U.S. Remember, it's the larger economy that mostly impacts us, so that's where we keep our eyes on it. There is a push in the U.S. to reopen faster, sooner than later. And this, of course, is due to the November election. The White House wants to open it as quickly as possible. They want to get the economy going again. They want to get business up and running. And they're doing all that they can to, bring the votes in, but, bring the goodwill back in. And that's been moving forward. One University of Washington, which is the main advisor to the White House, has suggested a staggered opening, and very likely what we're going to see in some format. And obviously it's already started in May. And here's kind of the graph that they've put out. So, kind of 4 states starting with relaxed social distancing, then 4 more, then 11 more, and they've gotten California in there by May 18th, May 25th, 7 more states, including Illinois. By June 1st, 10 more states, including New York and Florida, and then by June 8th, seven more states, which represents a large, over 50% of the U.S. GDP of this staggered opening. So that's the plan. Obviously, there's a lot of eyes on a second wave, and that's the rationale behind this staggered approach, is to not test it out in certain areas, but slowly adjust the openings as we see the success. If we do see a second wave, or we do see an increase in infections, or if we actually maintain that flatter curve, allowing us to continue with the economic opening through into June. So that's good news on a lot of fronts. We are going to start to open again. We're seeing this in Canada, of course, as well. We have already seen some provinces starting to slowly open, and also the bigger provinces, BC, Ontario, Quebec, are also starting to talk about how it's going to open. Obviously, it's going to be a slow and steady pace of continued social distancing, continued caution when we're out there. More and more companies are insisting on wearing masks. If you don't have any masks, there's a lot of online places to buy the reusable ones. Everything from homemade to charities are doing it. I know the Vancouver Aquarium is trying to raise some money to keep their doors open, and they've teamed up with our local soccer team, the Whitecaps, to sell some charitable masks. And you can also get the disposables. I think some of the local stores, I know Canadian Tire had some. I'm sure a lot of other ones have them as well. to have a few in your car, have a few around your house, just because a lot of the stores, I know Costco's starting to insist you wear them, and more of the grocery stores. So then that's probably going to be a trend for a while that we see as things start to reopen, is more things available, but still with a lot of caution. So that's kind of what we've seen in the economy. As far as the numbers overall, we will quickly review here. Again, the US, about 1.2 million infected. They've broken through 70 on the death numbers, and the new estimates that they will break through 100,000. Obviously, that's not the greatest news, but hopefully that will flatten. It's been holding steady at the number of new infections and deaths on a daily basis, but we've seen a couple of surges in some smaller towns or smaller communities, which is not a great sign. But we'll keep really close on that. Canada's the curve, as they review, has been holding steady and declining. We've seen a couple of surges, but still positive news for reopening throughout May and into June. Obviously not a full opening until much later, but we'll keep you up to date on that. So where are we today? What happened last week, and what have we seen coming up? We continue in the markets with earning week, or earning season rather, as we're into just going into our third week of earnings reports. And not a lot of big surprises coming along the way. Oil, we talked quite a bit about last week, where we went to the negative numbers. We've seen that rebound a little bit. I wouldn't get overly optimistic about the rebound, but I'm not overly negative about it either. We've seen some drastic cuts to production, which is helping with the price, because the big problem, if you remember from last week, is storage and way too much supply, not enough demand. So demand will slowly start to pick up as we reopen, but I wouldn't look for a big change on that front. We are seeing oil into the low 20s, or mid 20s actually, on futures. But June deliveries are still showing a little bit of weakness, which isn't surprising. But we'll see that continue. The Canadian dollar is held in quite well despite that. We're expecting Walt Disney to report this week. Of course, they've been closed, so we'll see the full effect of that on their earnings. The U.S. is expected to release their trade balance, and expected to drop. In fact, they just released, just before going live with this early this morning, they released their debt. The current spending on the stimulus is $4.5 trillion. So obviously that was a big number, which we'll have to deal with in the coming next couple of quarters and into next year. Obviously, with the election, that will be a big point to deal with in the campaigns. Activision Blizzard, so one of the video game producers, is about to release their numbers as well, and of course we're looking for stronger numbers across the board in gaming, as people, especially the kids being home, are able to be online a lot more and buying more games. In the U.S. specifically, the U.S. airlines shares tumble, not really surprising there. Buffett selling that off. There's been a lot of chatter around Buffett selling off his airlines. Now, keep in mind, he's been buying these since 2015, 2016. He did add earlier in 2020 and late 2019 to some existing positions. Actually, none of that surprises me. If you've been a follower of Warren Buffett, he's actually been not a fan of airlines. I was actually more surprised a couple of years ago when he started buying them, because he's always kind of held that he would never buy airlines. So the fact that he's blowing them out is probably just a kicking himself decision, in the sense that he probably thinks he probably shouldn't, he should have never bought them in the first place. So that's not really worrisome. I know some media has been talking about that's a negative signal. It's probably not a positive signal, but I wouldn't read too much into it. As we mentioned, Trump is eyeing, restaurants and boosting travel. looking at doing some tax changes. We haven't heard too much more there. J. Crew filed for bankruptcy. We're going to see more of this, especially companies that were struggling before. J. Crew was on a shaky leg going into this, and is closing its doors. So not a big surprise on that one, and we will see a lot more of those. We're reading a lot and hearing a lot about the meat production in the U.S. slowing down as the outbreaks inside the meat supply chains have been massive, causing closings, and the U.S. government's putting a lot of pressure for them to reopen to prevent any more disruptions. There's been a lot of pushback, and this is an industry where we're probably going to see a lot of change into. The virus has obviously demonstrated a big weakness in the process. People working close together, people not being able to protect themselves. So not sure exactly what changes we're going to see there, but I would expect that industry goes through a massive revamping due to the virus, as they try to figure out how to avoid this in the future. Again, on the aviation front, more job cuts, and again, not overly surprising as we see those come out. In Canada, as I mentioned, we're seeing some reopening. In Quebec, which was one of the harder hits, is opening. Montreal is still being a lot more shut down, as the more dense city in the province, still citing a lot of concerns as they work on a reopening plan. Air Canada, again, posting steep losses. Not surprising. They've closed down most of their flights. They've not flying to the U.S. at all until later this month, and of course the international border is being closed. So until we see some changes there, we wouldn't be very bullish on Air Canada, or any airline for that matter. Bank of Canada still working hard, constantly changing the quantitative easing packages and support for different groups. They're continuing to look at different industries, whether it be airlines, oil, and even special interests. As we mentioned last week, they started helping the university kids who are having trouble finding work this summer. So we'll try to keep you apprised as those things change and along the way, but they're still working hard to come to solutions to keep the economy running. So let's talk about strategies. When we talk about active management, I did talk early in one of our earlier sessions about passive management and how it is very challenged, especially in volatile markets like this. So I'm going to touch a little bit on why that is and why active management becomes a lot more important in your portfolios, and why we implement it to keep your portfolios performing in times of volatility or times of risk. So what is active management? Well, it's an active manager, a person or people, team in our case, who review all the research and data, and then use experience and judgment to analyze that data and to look at it in a way that we can approach it in a way to increase your performance and reduce risk, because that's always our goal, versus passive, which is better known as indexing, where it's kind of that buy and hold, which is the common term. So when we start to build a portfolio, if you start to build a portfolio, where do you start? And that's the biggest challenge, and that's the biggest risk, is when you take that first step, where does that lead you? Do you not diversify enough? Do you over diversify? Are you over diversified but in the wrong areas, meaning putting your portfolio at more risk? And we'll examine that a little bit. Well, let's start. What is risk? Here's a photo my family asked me to pose for. They said they picked the spot for me after 6 weeks of being shut in together. They decided this was a great spot. But risk in our personal life is pretty obvious. When we're talking about risk in portfolios, of course, we know that's, what possible outcomes, higher risk, higher return, and the more chance of losing some of the money or maybe all of the investment is how we look at risk. But more importantly, how do we quantify risk in your portfolio? And that's a number we call standard deviation. And standard deviation is simply the range based on historical numbers, based on either that investment or a similar investment or that industry, the range in which it has gone up and down during a set period of time. So we calculate that as a standard deviation. And that tells us historically how has this particular position done over time. And it looks a little bit like this. So, you know, 1 on this chart is telling you very low risk or no risk whatsoever. You know, lower return, you know, the fluctuation is very low. And the diamond there is the average return within that bar. 2, a little bit more risk, all the way to 7, where it's showing you the average return or the expected return of that, that level of risk. But it shows you the average, and it's important to identify that this is the average range for that type of investment or that particular sector of how high it could go or how low it could go on average over whatever period of time you're looking at. And I say average because when we talk about risk, it doesn't mean absolute. Those red dots show how low it actually peaked. So it could go lower than the average, the blue bar chart, the blue bar top and bottom, for a period of time, temporarily, but it could peak at a much lower spot and then average back within its normal range. So it's important to understand the difference between absolute range versus average range. And a lot of firms, a lot of portfolios, people will talk about these average range, but not your absolute risk. And it's important to always look at your absolute risk. So what do we do with this? Well, back in 1952, a gentleman named Harry Markowitz came up with a theory called the modern portfolio theory. So good news for everyone who was born in the 50s, you're still considered modern. And you can call yourself that because we still call it the modern portfolio theory. Where he analyzed that with a balance of combining different securities or different asset classes, to be specific, you can minimize your risk and maximize your return. So it sounds pretty normal to us today. We use this actively in portfolios, or the industry certainly uses it actively in portfolios to this day. And this is the theory that he came up with. In 1990, he actually won a Nobel Prize for this. Don't worry, we're not going to dive into this math. I would not bore you that badly. I am going to highlight how it's used, and you'll actually recognize this theory when I take you through this very brief process here. So the basis of the theory is pretty simple. If you look at that green straight line, low risk, low return, as you increase risk, your expected return goes up in a fairly straight line. But what his theory surmised was that there was this efficient frontier. So by mixing two asset classes, and specifically what he looked at were fixed income or bonds and equities or stocks. And by mixing those, he could actually change the outcome of your return. And there was this efficient frontier, that tangent where it hit the perfect line, where you maximized your return and you minimized your risk. And that's often called the balanced portfolio. And that's sometimes it's 50-50 mix, sometimes it's 60-40. It's always kind of in that mid-range, and the common term is called a balanced portfolio. You would recognize it as this. If you've ever been into a bank, they probably had you fill in a little questionnaire, and they've come up with a portfolio and they said, you know, here you go, your 60-40, your 50-50 balance, or your growth, maybe your 80-20, or your big risk taker maximum growth, which is 100% equities. Now you notice this curve looks a little different from the last one, because what Markowitz found in his formula there is you can actually be above that flat line in your returns. You could actually have higher returns with lower amounts of risk by blending these two asset classes. And the reason that worked in the math and in reality is something called correlation factors. So correlation, pretty simple. Correlation numbers is a ratio always between 1 and -1. If you're 1 correlated, this is a graph of a 1-to-1 correlation, meaning your blue wave there works completely opposite of your red wave. So if one goes up, the other one goes down. So it's a 1 correlation. And a -1 correlation, oh, sorry, it's a -1 correlation you're looking at. A 1 correlation would be they both acted exactly the same. -1 is they act completely opposite. Most securities, most asset classes are a range, 0.7 correlation, 0.4 correlation, -0.4, -0.7. So usually it's in that range, but we use those correlations to build a portfolio in order to protect you, to smooth out that line. If you look at that green line in the middle, we try to smooth out the line by having different investments, different asset classes, different geographies, in order to use those correlations to smooth your line out, but still get you the maximum return for the amount of risk that you're taking. There very rarely see a complete one or negative correlation, but that goes back to what I mentioned at the beginning of that over diversification or the wrong diversification. Is if you're buying a list of 10 different equities or 20 different equities, but if they're all positively correlated, you're not really diversified. And an extreme example in our current market is, if you go buy an airline and you go buy a hotel and you say I'm diversified, well, really those two are very positively correlated, because as people travel more, they stay at hotels more. So you can see where that positive correlation would come in. Where Markowitz used for his modern portfolio theories, specifically that fixed income class versus the equity class, where they were partially negatively correlated, meaning when the economy was doing well, equities or stocks were going up, but interest rates would go up as inflation increased, which led to lower returns on the fixed income. So they were oppositely correlated. And conversely, when the economy was shrinking, we'd be cutting interest rates, which increased the performance on fixed income, but decreased it on equities. So that negative correlation came into play to create that curve. So the 60-40 became the standard for the industry. And I can't think of any fund company or bank that doesn't put out that model portfolio and tells you, buy and hold. It's a very common strategy thrown out there that, that's the best mix. And you probably recognize those 60-40 or that efficient frontier more along the lines of this, to your risk-free, your capital preservation, as I mentioned, the balance in the middle there, growth or capital appreciation. Most industries out there have some sort of percentage mix that they say is their optimum tweak on that efficient frontier. Well, one of the challenges with that is what we've seen over the years since 1952 is this herd mentality, not herd immunity. Herd mentality is we've seen a constant flow in the same direction and the same behaviors, which kind of leads to this trap in using just that 1952 formula to create a portfolio. So be very cautious about that passive or that buy and hold strategy. When we look at times when the markets have been under stress, now that theory still holds true when markets are not stressed. When we're in good markets, correlations tend to trend back to the modern portfolio theory numbers. But when we get into times of stress, when there's added factors pressing on the economy, and there always seems to be an added factor on the economy these days. If it's not COVID, we had the China-US trade war, we had Brexit, we now have the battle over who caused COVID layered onto the China-US relationship and even global relationships. We have elections, we have oil battles, pricing battles around oil. So we have all these different pressures on a normal market, which is really playing havoc on this correlation. So if you look at this, and I apologize for this, I pulled it off to try to examine all the different asset classes, but you can see all those colored lines, how to the left of the screen, you see that the correlations are pretty standard all along the way. They're moving either in tune with each other or opposite of each other pretty effectively. And then you get a point in time where the markets go to extreme stress. So something's pushing down on the markets or pushing pressure into the markets. And we see them start to converge. And here's a close-up of the 2011 European economic crisis kick in. And that wasn't even a big crisis. It mostly affected the Eurozone, but we saw global indexes whether it be fixed income, whether it be large cap, small cap, geographies didn't matter. We saw a massive positive correlation across the portfolios. So what ended up happening there, that balance or that 60-40 mix, buy and hold, failed you for a period of time. And that's, if you remember in the earlier graph where we had that red dot where it went beyond the normal average risk of your portfolio, a lot of people found themselves underperforming or much higher risk in their portfolio that they gambled for. So using that fix, and we've not used that fixed 60-40 or a buy and hold strategy for over a decade, and this is the reason why. And in fact, if we go back in time and we look at those correlation trends, since the early 90s, we've seen a steady positive correlation of, or increase in positive correlation of different asset classes. And that's that herd mentality in the markets. Everyone moving at the same time, everyone moving in the same way. Information flow today versus in 1952, of course, is massive. You used to have to wait for your local newspaper to actually report on something. It might have been a week later or two weeks later. And then you might not even hear about different geographies. Today, everything's pretty instantaneous. The market's much, much more efficient. So it's a lot more risky. So when we see those correlations start to increase in a given market, that tells us, or that should be telling you, to really take defensive positions. Doesn't mean get out of the market. You'll never be able to time it. No data point will tell you when to get out or when to get in exactly, or even with too much range of certainty. But it does tell you trends and when the risk is increasing. And if risk is the first and foremost strategy in your portfolio, you should always bear heed to those warnings. And that's why, if you listen to our previous sessions, our portfolios going into this were between 30 and 40% in cash or cash equivalents, because we saw that risk correlations increasing. That had nothing to do with COVID. It had mostly to do with economic numbers and economic pressures. As I mentioned, we had a lot of them pushing down on the markets in the late part of 2019. And that triggered our portfolios to say, we need to de-risk a little bit here, because there's too much probability that we're going to positively correlate in the very short or near future. So being very cautious of that buy and hold and going for that full ride is something you should always consider, and make sure that you build that into any financial plan. Just think about it around your house or in your lifestyle. You would not use a technology around from 1952. And it's very funny, when we were doing this, I actually remember it as a kid having that washer with the ringer on top. And I hated that thing. The number of times I got my fingers pinched in that. I'm so glad we don't have those things anymore. And modern technology, of course, has come a long, long way. And we've talked about that at different times when we go through evolutions in technology. And that's kind of what we're seeing right now. This downturn or this virus has caused industry as a whole to relook at how they do things and to modernize. And the ways we did things in the past is not how we want to do that in the future. And that should be the same for your portfolio. So if you haven't been using active money management, or you haven't used it, or if you've been using the buy and hold or Markowitz strategy, do consider really layering risk in. And what that looks like is Markowitz graph is no longer a two-dimensional linear graph. We're seeing this third dimension, which is that correlations. We have to look for that correlations. When correlations are acting normally, great. We can keep the course. We can maintain standard risk in the portfolios. But when we start to see a breakdown in those correlations, it's time to dial back risk. It's time to look for safety, whether in the types of positions that you own or in just going to cash. There's been many times through my careers I've had to explain myself for periods of time, whether it be 3 months or 6 months, why we're not getting top performance in the portfolio. the tech crash of 2001. I remember being very heavy cash and refusing to buy any technology for about the last 6 months of the upswing of that, and having many clients talk to me about, that they're missing it, they're missing the opportunity, but of course not taking the big hit when it did go down 6 months later really paid off for the portfolios. And I'll actually give you an example here. And the same was true in 08. Sorry, I lost my screen. I'll get us back. The same thing happened in 08. We were actually up to 80% cash. The correlations were very high there. We couldn't find any good deals. We kept building cash, and a lot of pressure from clients as the markets were doing well in late 07, as we built that cash position. And of course, those signals ended up being cracked, and not too much pressure from clients this time around, as it was pretty short-lived. From our late October move to cash to COVID. Obviously, without COVID, it might have taken a few more months before we actually saw some pressure downwards. So, so what does this look like? So this is a graph. It's that you'll see buy and hold funds or portfolios throw at you all the time. And it's basically saying, the orange line is the blue line is the world index, basically saying if you stay invested, go for the full ride, here's your performance. If you try to get out or move to cash and you miss just 10 of the best weeks over, this is over almost a 15-year period, you get the orange line. So your performance is much lower, and it's a good argument. You don't want to be completely out all the time. We weren't completely out of the market. We moved into defensive positions, as I mentioned. We moved into power companies and grocery stores and the more recessionary performing types of positions. We didn't get out completely out of the market, but that just shows the extreme. It's very, very popular. But look what happens when we layer on a strategy like ours. So those two, orange and the first line is still there at the bottom, but that top line is if you miss the worst 10 weeks during that time period. So it's much more powerful, it's much more impactful on a portfolio's performance is to miss those big negative periods. Yes, you might give up a little bit on the upside, for short periods of time, but to de-risk the portfolio makes a massive impact on your long-term performance, especially when your goal is perhaps retirement or long-term income. Having to withdraw money from the market or sell at those lows has a very big negative on the portfolio. So being able to de-risk a portfolio through a volatile period is much, much more important than just closing your eyes and hoping for the best. And who uses this more than anyone? Warren Buffett, as I mentioned earlier on, people that were talking about his airline strategy. But keep in mind, he just had his public talk last week. He has 137 billion in cash, and he had that going into this. He was removing money from the market. Yes, he had billions in the airlines, and I think it ended up being about a $3 billion hit to his overall portfolio. But it's all relative. His portfolio is a lot larger. He's got 137 billion sitting in cash on the sidelines, and as of last week, he said he's willing to move into the market. He just can't find anything that looks attractive right now. And that's what we've been talking about in our previous sessions is, yes, we've seen a relief rally here from the bottom. Is it going to hold? Probably not to this level. We'll probably see it back. Will we retest the bottom? That's the unknown. But it's not a screaming deal out there for a lot of sectors. So patience over a few weeks, maybe a month or two, is really going to have a much bigger impact on the portfolio in the long run than jumping in blindly without the right data or without the right opportunities. And if we look at, and I'm going to close my little box here so you can see the graph. Oops. Oh, hold on. There we go. I'm out. So you can see here, even going into this, you can see where the smart money was raising cash. So the black line there is money market assets. The purple line is high interest yields, and then money market funds as well. Massive increase to cash at the very late part of 2019 going into 2020. And that's what we implemented in our strategy. And we still see those cash levels today. They've started to deploy a little bit, but the bulk is still on the sidelines. We haven't seen that level of cash since back in 09. And then we also saw it in 1964, where there's a massive correction into the markets. So keep that in mind. Cash is king right now. Looking for the right opportunities. Buy and hold in the wrong positions is not a great strategy to keep your portfolios going. So that is it for this week. As always, a little bit about us. We are a global firm, actually much more global than we used to be. Still Canadian head office, but our UK and Australian operations and throughout Europe, actually quite a bit larger than Canada these days. So we were able to pull on all that data. As far as time goes, we're right on time. So I want to thank everybody. I don't see any questions this week. Next week, we will be sending out our topic in the coming days. But we do drive these topics based on your feedback and your questions. So if you want to see something in particular, you want to discuss, whether it be more talk about individual positions, more talk about portfolios, the markets in general, please send in your questions. You can, obviously you have our email address, you can call us. If you're watching this on the replay, do feel free to share these to anybody from the replays. I know we've had a lot of people watching it at different times. We should have a link to our contact information down below. And we'll see you again next week, and talk to you all soon. Stay safe, enjoy the sunshine, and we'll keep you up to date as best we can. Thank you all.